It's Monday, August 29th, Monday show live. I'm Will Woodall, joined as usual, by Mike Rarey. Hey, Mike.
Hey, Will.
We're going to look back at last week. A lot went on last week. Jackson Hole conference, market sold off after Jerome Powell's comments. We're going to look at that. And we'll also take an updated look at our growth, inflation, and money supply forecast, and talk about some corollaries to inflation in the 70s and how the Fed reacted. We can look at the sell-off that has now sort of erased the gains for the month.
Yep. Yeah, last week, large cap equities down over 5%. That was pretty much all Friday. Growth stocks underperforming value stocks in the large cap space. And so those negative returns last week sent growth equity indices and the NASDAQ, for example, back into bear market territory, meaning they're down more than 20% year to date. And similar trends in non-US equities, developed and emerging markets, both with some negative returns, although not nearly to the magnitude that we saw in the US.
Yeah. And the damage also extended into the fixed income markets. We can throw that chart up here, take us through the rough week here.
We saw the U.S. Treasury yield curve move slightly higher during the week. Really didn't move a lot on Friday as a result of Jerome Powell's statements, but negative returns for U.S. Treasuries. And then as we go down the board, as you get more exposure to credit sectors, so things like high yield bonds, for example, more significantly negative returns there. Credit spreads widened out as the stock market sold off.
Yeah, so maybe for the viewers, just explain. So you look at TIPS, which are inflation-protected bonds. Why were they negative for the month?
Yeah, so Treasury inflation-protected bonds, yes, they give you larger coupon payments as inflation is hot, which is nice, but they also are sensitive to rising interest rates. Mm-hmm. And so when interest rates rise, TIPS usually lose money. So a lot of folks that were relying on TIPS as an inflation hedge this year have been pretty disappointed. I mean, they're down over 6%. That's why you need to have a diversified inflation hedge, which includes things like commodities, which have been the true inflation hedge this year.
Yeah, as we'll see on the next slide, because commodities, energy in particular, once again, was very strong.
Yep, energy. So seeing crude oil prices tick up a little bit. Another strong week for grains and softs. So wheat, soybeans, and then as we get into softs, things like coffee, very strong returns. More concerns coming about crop shortages because of unpredictable weather patterns, lack of fertilizer, poor planting season, et cetera. And so more and more fears of how that might exacerbate a global food shortage.
Yeah. So let's turn to the news of the week, which was the press conference, the 8-minute press conference.
Yeah.
It wasn't really a conference, it was just a statement.
Right.
And we have a few soundbites from here, but take us through what Jerome Powell said and what the market sort of reacted to.
Yep. Yeah, 8 minutes. Very short and sweet statement. No Q&A afterwards. This was actually the first time that the Fed chair's statements were live casted from Jackson Hole. And based on how the market reacted, who knows, it might be the last time. But basically, he wanted to deliver a clear message that, and this was pretty consistent from all central bankers that spoke on Friday. So from other central banks around the world, consistent message that they're willing to raise interest rates higher and keep them there for longer, even if economic growth struggles or slows down because of that, and even if there's weakness in the labor market, in order to not relive the policy mistakes of the great inflation era, which were, mid 1960s through early 1980s.
Right.
And it was kind of a mic drop, for lack of a better term. And equity markets started selling off while he was speaking and just continued for the rest of the day.
So after that, we saw the expectation for rate hikes increase. Now we're expecting over 5 more rate hikes for the end of the year.
Yeah, something like 3.75 should be the peak for this cycle, somewhere around March next year.
Which, just give context, right now the 30-year bond is around 3.25.
Yeah.
So you'll have inverted the entire curve at that point.
Yep.
Let's talk about the corollaries to what he said relative to what happened in the 70s and early 80s and how it was handled and what we might learn from their resolve here.
Yep. Yeah. What were the actual lessons from the 70s and the 80s? And so we'll throw up this busy chart. The overarching theme was central banking back then. The idea was that you should favor low unemployment and accept the trade-off of higher inflation. And so this is viewed, the Great Inflation is viewed as one of the worst periods of macro policy in American history. And so essentially what happened was inflation started rising. So we have headline CPI here, it's the light blue line. Inflation started rising in the mid 60s and got uncomfortably hot as we moved into the late 60s, early 70s. And you saw the Fed funds rate rose commensurately. And after the Fed funds rate was tightened quite dramatically, we went into a recession. But then importantly, the Fed did not have the resolve to keep interest rates high enough to actually defeat inflation. They then cut interest rates because they were not willing to accept the consequences of restrictive monetary policy in terms of weakening labor market, weakening economic growth. So they subsequently cut rates, and what happened was money supply growth shot up again. So that's the green line. Money supply growth year over year during this time period was running well above average, very hot, far hotter than where we think it's going to be headed in the future now. Mm-hmm. But you saw, and they went through this cycle of not being willing to tolerate the consequences of restrictive monetary policy over and over. And we had 4 recessions during this time period. And finally, Paul Volcker became the Fed chair in 1979. And he did what other Fed chairs before him were not willing to do, which was raise interest rates uncomfortably high and keep them there for longer and intentionally slow the growth rate in the money supply until inflation was finally defeated. Mm-hmm. And those were the lessons of the 70s and 80s. Thankfully, we went through them back then, so we don't relive them, hopefully. But that is the idea, that the Fed this time around is going to raise interest rates, keep them high, even if there are economic consequences, even if there's political backlash, even if the fiscal authority looks to undermine them.
So that being said, what does this do from if you're Jerome Powell and you're saying, I'm going to defeat inflation, and we have to keep rates higher for longer than the market is anticipating right now, because right now they're expecting a pivot sometime next year. Mm-hmm. Mm-hmm. How does that play itself out?
Yeah. What Jerome Powell said, how that translates directly to our expectations for the Fed funds rate, what we think the market should be pricing in, is yes, you should expect more hikes than you previously thought. That got priced in. But the idea of rate cuts in the back half of next year, which is still priced in, those seem like they are totally unwarranted. What this speech says to us is the Fed was too late to raise interest rates in this cycle. They might keep them high for too long coming out of this cycle because they're so afraid of reliving the 70s and the 80s. And so the idea that they're going to cut in the back half of the next year, even if there's a recession, that if they're going to make a mistake, they're probably going to err on leaving rates too high for too long.
And potentially extending a recession longer than
exactly
it could be.
Yeah.
So this is an interesting comparison because of the money supply and what we're witnessing in the money supply globally, which is, I think, on our next chart here.
Well, inflation first, right?
Yeah. Okay. Yeah. Because we're really forecasting inflation to come down fairly rapidly.
Yep. We're expecting high and falling inflation, and so the Fed has inflation models as well. So if we throw up our inflation forecast, we can show there are some key metrics here. Yes, we think inflation will be falling. However, it's going to be high for an extended period of time. And the Fed has access to a lot of the same data we have access to. And that's why they had to come out so forcefully with their words, because they know the next few months here are going to be really frustrating for everybody. Mm-hmm. Because our inflation forecast shows that headline CPI isn't going to drop below 8% until January. And core CPI is probably going to move back up year over year, back up over the next 2 months, and won't dip below 6% until January. And you have 3 Fed meetings between now and next January. And we're starting to see the negative consequences of what the Fed has been doing in terms of slowing economic growth. It's going to be a little while before we really see the positive consequences in terms of bringing inflation down. And so they had to come out with big words, say they are resolute in bringing inflation down, because they know it's actually going to be a little while. But once it starts coming down, we forecast it should come down quite rapidly.
Yeah. And that's, we're probably looking at like from now till January, that's a lot of time still left on the clock for economic things to continue to break down. And how do we think about that in the context of the money supply and how the money supply is evolving here, which is our obviously our next chart, the path of liquidity, which we see decelerating to lowest rate of change ever.
Yeah, exactly. And this is specifically what they're doing. So when we think back to the 70s and the 80s, Paul Volcker specifically targeted money aggregates, slowing the growth rate of the money supply. And he did that to bring year-over-year change in money supply somewhere around 5%. Well, this is why we don't think we're going to relive the 70s and the 80s, because we're expecting that money supply growth this time around is going to get to something like 0% year over year and probably stay there for an extended period of time. That slowdown in money supply growth will be the most dramatic we've ever seen. And if that doesn't defeat inflation, then there's not much more you can do. I mean, you can't make money supply growth negative. You can't literally go out and burn dollar bills. So that's about as much as, and it seems like they're willing to do that. And that's why once that starts to bite, that's when we should really start to see inflation come down.
Come down fast, yeah. In terms of, I guess, a question we got recently was, what impact on liquidity or money supply does something like the student loan forgiveness bill have?
Yeah. So, that is an inflationary type policy. I mean, money is fungible. So for all those folks that have student loans outstanding, if $10,000 of that gets forgiven, well, then that frees up about $10,000 worth of consumption or demand without necessarily increasing supply to offset that demand. So, it is definitely inflationary. Now, we don't think this is the government undermining the Fed's efforts by any means, which is what, Arthur Burns had famously complained about when he was a central banker in the 70s. But, these are the types of things you see. When the Fed induces a monetary slowdown and the economic growth starts to get, poor, especially around election cycles, politicians are incentivized to some way, shape, or form provide stimulus.
People, yeah.
And they'll put whatever wrapper on it they need to.
Yeah. So let's just shift gears and look at the data, because we did get some recent housing reports that showed considerable drop in single-family home prices, and we're starting to see some of the economic data come down. But let's talk through what we have on this chart here.
So we talked about how expectations for GDP growth this year have been coming down all year, and the data has been coming in worse than expected. So this is the magnitude to which the data is coming in worse than expected amongst the different areas of the economy. And the number one offender has been the housing market. And you think about the elements of the housing market that actually impact the GDP number: new home construction, existing home construction, renovations, and realtor commissions. And all of those have grinded to a halt. So new home sales, the data that we got recently was extremely weak. Existing home sales have all but dried up because mortgage rates are moving back up again and basically stalling out the housing market, pricing certain cohorts out of buying and selling. And so that area of the economy since May just cannot reduce expectations fast enough. Data just keeps coming in worse and worse. And it's really just the labor market and retail sales that are, that are doing any type of lifting. Not really heavy lifting, but some lifting. And the labor market, it's because non-farm payrolls have been great. It's important to note, though, the establishment survey, where the non-farm payrolls report comes from, historically gets revised down after we go into an economic downturn. So it's everybody's sort of hanging their hat on this idea that there's no way we're in a recession right now because we had 500,000 jobs added last month. And they're right. If we had 500,000 jobs added last month, you're right. We're certainly not in recession. We just question that 12 months from now, we're actually going to say in July 2022, there were 500,000 jobs added. That data historically gets revised down quite aggressively around economic turning points.
Right. So explain, because that's a big statement. Like, could we go from 500,000 to negative 100,000?
Not the base case, but you can confirm the establishment survey. You can confirm that with the household survey. The household survey has been flat for the last 3 months or so. And if you go back to 2008, for example, the unrevised non-farm payrolls report heading into that recession, they were positive, in the order of hundreds of thousands, and ultimately got revised down to flat and then negative. So it's not our base case. It's a low probability, but it's a probability,
And in terms of retail sales, what is driving the continued sort of expectations or strength here?
Yeah. Retail sales data it's in nominal terms. So basically what happens is because prices are higher and consumers have savings, they're spending them. And that's showing up as strong retail sales data. And it's true. That's the dollar value of the retail sales data. Now, are consumers actually consuming more product month over month? No, they're just paying higher prices for consuming less product. So that would be how we would look at that data. And even these positive surprises, you look at the green bars, they're really not significant. I mean, let's not lose sight of the fact that we had 2 negative quarters of real GDP growth, and expectations for the full year are now basically zero for the full calendar year. So
slight uptick in the recession forecast, mostly market data, right?
Yeah, mostly market data. Just the sell-off last week factoring into this, the sell-off in equity markets, high yield bond spreads widening out, and then a little more of the yield curve getting inverted. So, but yeah, right where we've been. So it doesn't really change our outlook a whole lot.
Okay. All right, well, here's a good spot. We'll take some questions here. Is cryptocurrency starting to look any better with all the volatility in markets? Well, no. It's a big question, I think. Cryptocurrency is definitely changing in terms of correlations over time. As we get more and more experience with it, it becomes harder and harder to sort of put a solid answer on how to invest in cryptocurrency as it relates to your other asset classes.
The few things we know from our framework are it's very liquidity sensitive. And if it has a high correlation to anything, it's growth stocks. And so we would just say, what's our outlook for liquidity and growth stocks? And that's still negative. So obviously, Bitcoin, for example, has come down tremendously, 70%. But is it attractive at this point? Based on our leading indicators of liquidity, we would say no. And then we would also say, what's the fair value of Bitcoin? So I have no idea. Do you do a price matters framework on Bitcoin? And who knows?
Yeah. Very volatile. All right, next question. If inflation keeps going up, what will happen to the US dollar?
Great question.
Good question.
So living in a fiat currency world, the dollar only has value relative to other currencies. And the relative value of a currency is primarily determined by short-term interest rate differentials. So if inflation keeps going up, but the Fed does nothing about it, then you would probably expect the dollar to weaken. But because inflation, if it were to keep going up, the Fed will likely keep raising interest rates. Our interest rates will look attractive relative to other countries' interest rates, which means people will sell those foreign currencies and buy dollars to get our short-term interest rates. So the dollar should actually get stronger.
And our base case is that inflation will not continue to go up. It will come down.
Yep.
All right, next question.
This is fun.
Does it make sense to buy the dips these days? Okay.
This is a time horizon question.
Yeah, it's always that. Like, so the big stories over the weekend were the bear market bounce. This was just a bear market bounce. The bull, that wasn't a bull market. So we're going to be heading lower because of this. So do you buy these dips, or you look at, like, if you're a day trader, maybe you do buy the dips. But if you're looking at fundamentals and the things we look at, it's probably still not a time to be buying dips.
12 months out, based on our framework, nothing's moved cheap enough that the macro factors don't matter in terms of equity. So no. If you're 25 years old and you're investing for 40 plus years, yes, you should buy all these dips. Every single one of them, you should be buying the dips, and you shouldn't worry about it, and you should just invest.
Yeah. Now, what you buy, as Mike said, like, you could be looking at things like utility stocks, staples, things like that, which would now on dips be good to buy, given our 12-month forward outlook. But high growth stocks, probably there's going to be better opportunities to buy those later.
Yeah.
All right. Do we have any other questions in the queue? If not, we can wrap it up there for this week. Looking forward to wrapping up August next week and look back at the whole month. And then we can also talk about portfolio positioning and changes that we've been making for clients for the previous month and for the upcoming month. So thanks a lot, and we'll talk to you next week.